Thank you for joining us at XM.com. This is a special report. I'm Cristina Marujos. With me today is our lead investment analyst, Rafi Boyajian. Rafi, the rise in bond yields has put markets in a spin as the Fed is doubling down on its higher for longer message. But the last time yields were this high, we were on the onset of a financial crisis. Do you think history is repeating itself?
Well, Christina, that is indeed a very good question because, of course, we do have a few trouble spots in the economy. But of course, we have to remember, first of all, why we are in this position, because even though we have seen a pretty significant drop in inflation, and the Fed is also happy about the fact that inflation expectations have settled at a pretty low level as well. They're not really, pointing to anything too worrying. Consumption remains pretty strong in the US. So the labor market is still very tight, even though we had, of course, those headlines about massive layoffs. But there are a few things of concern. For example, the manufacturing sector in the US is contracting. We are seeing tighter lending standards by major banks. Lending by major banks is slowing. We are seeing some signs that credit card delinquencies are on the up. And of course, we've got other complications such as the slowdown in China. However, none of these signs are conclusive that the US is headed for a recession. So based on all the evidence, everything is pointing to a soft landing. And as long as we stay in this sort of Goldilocks situation, the Fed is going to continue to reiterate that it has to keep rates higher. It has to keep rates high for a longer period of time to make sure that inflation goes all the way down to 2%.
So, Rafi, if the soft landing scenario remains the base case, how much higher can yields go?
Well, that is what everybody wants to know because, of course, just a few months ago, nobody would have imagined that rates would have reached as high as, say, 4.7% for the 10-year yield. The 30 yield has also rallied sharply. So it's interesting that in this latest sell-off in bonds, it's mainly the long-term bonds that are being sold off. So that's why we're seeing yields on long-term bonds reaching this very high levels. But I think, it goes pretty much without saying that at some point something will break. Where is that going to be? It's hard to put a precise number on it. Potentially, we could see things start to break when we reach that psychologically important, psychologically significant 5% level. We still, though, have the yield curve inversion in place. That's still pointing to a recession. So we are not out of the woods. We may yet see a recession. Should we see, though, in the meantime, until we get those more concrete signs that the US economy is going into a difficult spot, yields will probably continue to rise as long as the Fed is maintaining its hawkish stance. And that would put in danger shares on Wall Street because although at the moment we are seeing a bit of a sell-off in stocks, it's been nothing dramatic, especially in comparison to the gains we've already seen. But 5% could potentially be that figure that could really spark more panic. But of course, these are the worst case scenarios. The other danger, of course, is that we are seeing a renewed rise in oil prices, so that's another complication for the markets to kind of add to their forecasts. But this is something, basically for the future. For now, I think both the Fed and the markets are happy to kind of go along with this, base case scenario of soft landing.
Rafi, thanks so much. This was a special report here at XM.com.